There's something happening right now in the US financial system that almost nobody sees coming, even though it directly affects your 401k, your index funds, and the long-term strength of the US economy. And that something is surprisingly simple. Nearly 41% of every dollar you put into the S&P 500 doesn't get spread across 500 companies the way you think. It flows into just 10. And one name pulls harder than all the others: Nvidia. Every dollar that enters the index sends nearly 8 cents straight into that single company. You never press buy Nvidia, but the moment you buy the index, the system buys it for you. This quietly turns passive investors into people making the largest AI bet in financial history, whether they want to or not. And when massive amounts of money concentrate into just a few companies, their stock prices inflate. Their market caps explode, their borrowing power grows, expectations rise, and the cycle just keeps spinning upward. But here's the problem. To justify their current prices, AI companies would need to produce $2 trillion a year in revenue. And that number becomes absurd when you realize that even if you combine the 2024 revenues of Apple, Amazon, Microsoft, Meta, Google, and Nvidia into one mega company, you still wouldn't get to $2 trillion. At the same time, these companies are gearing up to spend nearly $330 billion in 2025 building AI infrastructure. And when Sam Altman casually says OpenAI is prepared to spend $1.4 trillion, the question becomes unavoidable. Where exactly does that money come from? Someone asked him that directly. Sam fired back, correcting numbers and offering to find buyers for anyone who wanted to sell their shares. The room laughed, but what came next wasn't funny at all. He said that to fund AI at the necessary national scale, the US government may have to get involved as the insurer of last resort. Phrase has only ever shown up before major financial disasters. It means if the system fails, the taxpayer pays. Altman later insisted it wasn't a call for a bailout, but the market heard the message loud and clear. No CEO accidentally mentions government backstops. Comments like that signal how enormous the gap is between AI's real earnings and its imagined future. And here's the uncomfortable truth behind the curtain. While AI companies are valued as if they're about to generate the largest profits in capitalist history, most of their spending doesn't come from profit at all. It comes from debt. Not simple, transparent debt you find on a balance sheet, but debt hidden inside private credit, SPVs, joint ventures, and complex structures whose entire purpose is to keep the true level of risk out of sight. This is the part that almost no passive investor actually notices. Most people assume that buying the broadest index in the market spreads risk, but in reality, the index now channels most of its weight into whatever grows the fastest. When 41% of your so-called diversified dollars end up flowing into a small circle of dominant companies, your portfolio isn't as wide as it appears. On paper it looks broad, but the real influence comes from just a few players, while the rest simply fill out the list. It's like standing in a crowded room where only a handful of voices actually drive the conversation. And because the S&P 500 is market cap weighted, that concentration gets stronger with every price increase. Stock goes up, gives up, buys more, gives weight increases, gives index buys even more. A loop reinforcing itself, making the US economy look stronger than it is. But zoom out 20 or 30 years, and you see the rhythm clearly. The dot-com bubble was built on hope. The 2008 housing bubble was built on leverage. Both collapsed when expectations outran reality. The difference this time is that AI has been framed as a strategic geopolitical priority, a technological arms race between the US and China. When governments see an industry as a national weapon, it becomes something close to too big to fail. And too big to fail is the most dangerous phrase in modern finance because it gives everyone permission to believe that someone else will catch the falling knife. That's why Warren Buffett, the most patient investor alive, is quietly building the largest cash pile in his career while trimming his equity exposure. And why Michael Burry, the man who called 2008, is placing nearly 80% of his portfolio in positions shorting AI-related names. Two men who almost never agree, suddenly moving in the same direction. Not because they dislike AI, because they distrust the price of AI. Meanwhile, something strange is happening on the other side of the financial system. AI stocks are surging, but Bitcoin, normally the high beta companion to tech, is falling. Not because of bad news, but because investors interpret the Fed ending quantitative tightening early as a sign that somewhere in the system, Liquidity stress is forming. Bitcoin reacts to liquidity before anything else. It's the canary in the coal mine. When liquidity tightens, Bitcoin drops first. Stocks follow later. And through all of this, AI remains the main engine propping up US GDP growth. Deutsche Bank has already said outright, without AI spending, the US would likely be in a technical recession. Which means the entire economy is now standing on two legs. One leg is AI itself, and the other is the belief that AI will eventually generate enough real revenue to justify the massive debt and spending happening today. If that belief cracks, even slightly, the whole structure shakes. So we're left with a simple, cold question. Is this truly the beginning of the next industrial revolution? Or is it a bubble dressed in beautiful numbers that hide the truth? Now that the mechanics behind the AI-driven market are clearer, the next question becomes harder to ignore. What happens when an entire financial system leans this heavily on a single narrative? Whether investors admit it or not, the US economy is now tied to the assumption that AI will deliver growth fast enough to justify the spending, the valuations, and the capital flows holding markets up. But markets don't move in straight lines. They move through cycles, periods of expansion, stress, and liquidity shifts. Over the last few years, the Federal Reserve has been draining liquidity through quantitative tightening. Normally, QT ends once inflation cools and the system stabilizes. This time, the Fed signaled an early stop. That alone is unusual, because central banks rarely change course early unless they sense pressure building beneath the surface. The market reacted instantly. Growth stocks jumped. AI valuations stretched further. But Bitcoin, the most liquidity-sensitive asset in global finance, moved the opposite way and sold off. That divergence matters. Bitcoin reacts to liquidity stress long before equities do. When funding conditions tighten, Bitcoin responds immediately while stocks continue looking healthy for a while. This timing creates a lag and illusion of stability, where the system appears strong even though pressure is quietly rising underneath. And the early signals are there. Corporate debt issuance is accelerating. Treasury auctions are becoming more unstable. Short-term funding markets need larger backstops. Consumer delinquencies are trending upward. None of these signals are catastrophic individually, but together they paint a clear picture. Liquidity is tightening at the edges, while asset prices remain elevated at the center. This is where the AI narrative becomes vulnerable. The biggest technology build-out since the internet boom is unfolding at the exact moment the financial system may be transitioning from liquidity expansion to contraction. When money is cheap, big ideas flourish. When money tightens, stories must justify themselves with actual cash flow, and cash flow takes time, far more time than current AI valuations assume. Over the next few quarters, companies that poured billions into AI will need to show results. Investors will want evidence, real AI-driven revenue, margin improvements from automation, and demand created by new capabilities, rather than hype. If those results arrive quickly, the market stabilizes. If not, the pressure compounds. Quarter after quarter, expectations tighten, funding becomes more expensive. Valuations become harder to defend. And the upward momentum loop becomes a downward loop. Prices fall, index weight shrinks, flows slow, momentum reverses. These cycles rarely stop halfway once they begin. But this isn't only about corporations. It's about the millions of people whose retirements are tied to the same trend. Most don't realize their exposure. They assume they're diversified because they own the index. But diversification today is thinner than it appears. When a small group of companies carries a disproportionate share of the index, the fate of many portfolios depends on the earnings of a few. For everyday investors, the impact doesn't show up as a sudden crash. It comes quietly through years of stagnating returns, shrinking multiples, reduced risk appetite, and markets moving sideways while inflation keeps advancing. Companies that scale too quickly slow down. Workers in AI-dependent sectors face hiring freezes or sudden cuts. On a broader scale, the social pattern is familiar: hiring pauses, political pressure to stimulate growth, households losing confidence in long-term financial planning. Momentum-driven economies don't stop with a shock, they fade. And fading often feels like confusion rather than crisis. If everything goes right, AI will produce genuine productivity gains large enough and fast enough to offset the massive capex, but that requires more than breakthroughs in capability. It requires deployment, cheaper inference, widespread adoption, and tools accessible enough for real businesses to integrate. It requires companies to convert technological excitement into steady, reliable revenue. If those gains take longer, the gap between expectation and reality widens. Capital becomes impatient. Valuations recalibrate. An economy leaning heavily on AI spending must find alternative sources of growth or accept a slower period. History doesn't repeat perfectly, but it echoes sharply. The dot-com boom wasn't wrong about the internet. It was wrong about timing. The housing market didn't collapse because homes lost value as an idea. It collapsed because prices detached from what incomes could support. AI is transformative. But the market isn't pricing transformation, it's pricing speed. And that's where the risk lies. Because if the timing slips, even slightly, the valuation framework breaks long before the innovation pays off. Investors are left with a cold truth. The technology may be inevitable, but the path the market expects is not. In the coming quarters, the distance between the story and the cash flow will define everything: asset prices, liquidity conditions, risk appetite, and the stability of retirement portfolios quietly built on passive inflows. Which leads to a final question. If optimism fueled the last cycle and leverage fueled the cycle before that, what exactly is fueling this one? And more importantly, how long can that fuel last before the market stops rewarding expectation and starts demanding proof? Because every narrative eventually reaches the moment where it must prove itself. And that moment is coming. If you want the breakdown before the headlines catch up, hit subscribe. I'll keep tracking the numbers so you don't have to.